we all should be investing in our retirement plans. Okay, if you're working for a W-2, obviously, right, you may have a 401k plan. You should have a Roth IRA. If you are an independent contractor, you should have an IRA. You should look into saving money for your future because Social Security may not be there. And are we going in a recession? I can't say. I don't know. My crystal ball is not that good. A lot of people say we are. I don't know. I think we're going to go into a slowdown because Fed is seeing something happening and cutting rates. Although the bond market is raising rates, it's just really weird time at the moment for me. I'm just trying to make sense of all of this because there's a saying on Wall Street, don't fight the Fed. Fed is cutting rates. Everything should be fine. Well, I don't know. It's the first time in my lifetime of doing this that the interest rates markets, bond markets, are saying to the Fed, go take a long walk on a short pier. We're not buying what you're doing. So how do you protect your 401k if you're 50, 40, 60, whatever, and you have a massive 401k accumulated and you have put it into ETFs or some mutual funds, and you've done extremely well, obviously, right? So if we go into a recession, what's going to happen to the stock market? I mean, stock market's going to eat it, obviously, but how do you protect your 401k during a recession? Well, a recession is a time of significant economic slowdown. We agree. Hopefully you keep your job, but even if you don't, if you maxed out your 401k contributions and your company is a decent company that matched you, you should have done extremely well. But in a recession, market will eat it, and then your statements that you get off your 401k are not going to look that good, right? Eventually they will recover. But should you trade your 401k? No, absolutely, because then you have to pay taxes. Should you just liquidate, go into cash in your 401k, which you can? That's one way of doing it. But timing the market does not work when it comes to 401ks and Roth IRAs. So there's a saying in our world that time spent in the market is much more important than timing the market. And let me say that again. Time spent in the market is much, much more important than timing the market, yo-yoing up and down. A workplace 401k is many people's first exposure to investing, which is absolutely correct. It can be exciting to see your balances grow and you keep contributing, and then it has the compounding effect, which is wonderful, right? But stock market pullbacks, like the recent sell-off that we had to the tune of 15% in 3 weeks, but then by the time you got your next statement, the market was back up to where it was already. I mean, you should worry about your 401k. It is most people's major part of retirement, because whatever you're going to get out of Social Security is peanuts, right? I mean, although COLA's cost of living adjustments have been great last 2-3 years for retirees to the tune of 5, 6, 7%. This year they announced that it's back to 2.5%, while the debasing of the currency is going, while the printing machines are going, while the U.S. national debt just about this weekend, I think, is going to hit $36 trillion. Your 2,000 that you were getting out of Social Security 3 years ago, and you're still getting 2,000 today, is not buying the same, right? The buying power is not there. So, you should protect your 401k. You should look into your administrator, talk to your administrator about possibility of, if you're getting ready to retire, maybe not be into stocks, right? Not be into mutual funds. Maybe you should be into bond funds. You should be into more income. This is all individual basis, obviously. You should definitely pay attention to what's happening to the marketplace, to not trade your 401k, but you definitely should have a balance, right? At this point, if my 401k is, so the rule of thumb in the 401k is that according to your age, that's the way you should. So if you're 25 years old and you're working somewhere, you're creating a 401k, you should have 25% of your, should be a 25-75 rule, right? 25% of your 401k should go into fixed income, 75% should go into high growth, aggressive funds, right? Because you have your life ahead of you. But if you're like me, at this point, you should be like 65-35, meaning 65% should be in fixed income. Yes, your returns are going to be less than the market probably, but you're at least going to protect your equity, your existing account value, and only 35% should be in more like high dividend paying stocks and things like that, mutual funds like that in your 401k. So always try to think what you could do according to your age, right? If you're young, you should be in all in aggressive mutual funds in your 401k and very little fixed income. If you're older, getting ready to retire, specifically the last 5 years, you should definitely flip that over. Be in high dividend paying mutual funds, less ETFs, more fixed income. So you protect what you built working at a specific company for, 20 years, 30 years, whatever it is, right?